might get so wild in the financial things, they'll just stop all markets. And then it'll be gold, and then they'll set new pricing afterwards. You've got to be careful. So that's why I'm saying this. Have a look at this chart on the Dow Jones, Jesse. I've been showing this to a couple of people now because this is really important. Dow Jones divided by gold ounces. Do you think central banks have reduced volatility and added stability, or increased and turned essentially the last century into three big pump and dump schemes? That's a bit of a loaded question. I'm imagining most people know where I'm taking them here. They were introduced in 1913, roaring 20s straight away. What do? They turn the turbo juice up, smash down into a depression. You went that 18.6 ounces bought you a basket of the Dow, down to 1.88. Then they wound up a major bull market and liquidity, which included the tail end of the Russian Revolution.
The speaker, Francis Hunt, warns that the gold-to-silver ratio could hit new highs, mainly if a major demand-crushing event occurs. In that case, silver would likely sell off harder than gold, meaning gold would be the safer asset during a correction. They suggest gold could fall to around $3,000, while silver could drop to $22. Although silver will eventually have its explosive moment, it will be much more volatile and complex over time. That's why the speaker prefers mainly holding gold, with only about 25% allocated to silver, in case market chaos limits the opportunity to react. Francis Hunt, also known as the market sniper, a trader, technical analyst, and educator, explains that the gold-to-silver ratio could spike much higher, reaching 170 or even beyond in a major financial crisis. In such a scenario, gold would dramatically outperform silver as big money flows into gold for safety, while silver remains suppressed due to industrial demand and market manipulation. They argue this is the biggest financial meltdown yet, and advise stacking gold more heavily for now, switching to silver only after a confirmed reversal in the ratio. Looking at the Dow-to-gold chart, they highlight massive historical cycles of pump and dump driven by central banks, predicting that this time, the correction will be even deeper, potentially with gold eventually outperforming equities as the financial system resets into a new era of control and CBDCs. Let's dive deeper into the video. If you find this information valuable, like the video and subscribe so you never miss our latest updates.
Because everybody was inflation trade, oil's going to go up, all of that sort of stuff. No, consumers getting wrecked and shutting everybody down. Very bad for oil price. We didn't know what was going to be the story. We just got the technical trade. That's why we're earlier than most people. And most people are not going to make this. And let me just be clear. There's going to be silver bulls. I'm a silver bull. Here I am. Where's my coin? It's somewhere here. And I am in silver, but I am stacking gold more aggressively. There's my silver. And I'm stacking because it's going to extend, in my opinion. This is a bigger crisis in terms of the financial aspects. We've seen that most times you got to 90, the silver ratio sold off. It's only in the big crisis you did that. This is the big crisis. And this is just starting, and gold is going to continue to outperform because the big players with the big money are going to keep stacking gold. They don't have the storage space, and they have hundreds of millions to hide. They have to buy way too much silver. And more importantly, the people that do this are the insider cartel, the banking cartel, and they want cheap silver a little bit longer for the military industrial complex that has 5 kilos of missile. It's a small enough market that can still be bullied a lot more, and the big money is going to chase gold. The big money is not going to chase silver. The retail money is going to chase silver, trying to jump to the next phase because they were late for gold. If they were following us, they weren't late for gold, and they should stay playing phase one until it's official that phase one is over. Phase one is over is when the gold-silver ratio reverses. If you can't afford $100, think about, what you're doing for income. That's a different problem, and we can talk about that separately. So gold should be bought now for the outperformance it offers. It's going to extend in our best view a lot higher. Then Once it turns, on my DCA, I go 100% silver. So if that's up here and we've just run the 171 and we get that slam down like that, right here, I go from buying 75% gold, 25% silver to going 50-50 to the downside, which will be somewhere around here. So this is something that's really important. And to people that are hearing me say this, that we could stretch that far, let me just show why I say it as well, because it's going to be a difficult, and this is a unique view. There isn't a gold bug telling you this right now, that the gold silver ratio could quite possibly take out the previous high, never mind going to 170 or 200. There's nobody. Everybody is whale into silver, guys, whale into silver. Let's be clear. You have a major demand destroying event and it sells off. Silver sells off more than gold. So it could be on a correction. Gold could correct back down to 3,000 and silver could fall to 22. It might get so wild in the financial things, they'll just stop all markets. And then it'll be gold, and then they'll set new pricing afterwards. You've got to be careful. So that's why I'm saying this. Have a look at this chart on the Dow Jones, Jesse. I've been showing this to a couple of people now because this is really important. Dow Jones divided by gold ounces. Do you think central banks have reduced volatility and added stability, or increased and turned essentially the last century into three big pump and dump schemes? That's a bit of a loaded question. I'm imagining most people know where I'm taking them here. They were introduced in 1913, roaring 20s straight away. What do? They turn the turbo juice up, smash down into a depression. Then they wound up a major bull market and liquidity, which included the tail end of the Russian Revolution into the Second World War, all the way up into the swinging 60s, 28.47 ounces of gold you needed to make it to the Dow Jones basket of average. When it collapsed, 0.99, sub 1. 1 ounce of gold bought you more than what you needed for a full basket of Dow Jones stocks. That was peak gold, peak Volcker. 2009 on the 6-month candle, by the way. This goes a whole century, so it's a 6-month. Each candle is half a year of the Dow Jones being divided by gold. 2009 is literally one hammer. Literally, you're at 7 ounces, and then you went down to 5 for QE 1, 2, and 3. Gold had started to move. Quantitative easing, the early people said, oh, this smells like money proliferation and devaluation. I'll hold something that doesn't get smaller every time. There is no bond market to create it. They go back to the beginning and we start again with CBDCs, UBI, lots of write-offs, lots of renegotiated pension deals. You must comply with social scores, etc. Take any medical interventions. And then if you do your push-ups, the chip in your arm will let you get so many tokens and you can buy your once a month beef burger in between your locust food. That's kind of how I see that going, to have a little bit of fun with it. But as you can see from this is a huge dump. And it's a far bigger cycle than just COVID. COVID was this in the Dow Jones. That's it, CV19. That's the event in the greater scheme of things. It's one of a few things. 2009, 2011, these are almost blips on this big chart. Here's your big main story of what goes down and what happens and how it works for gold. And that is, if you go to 0.5, for example, that's a 24 times overperformance for gold relative to the Dow. That means if the Dow actually succeeded in staying where it is, which I don't believe, but I believe it re-rates, your gold would go up 24x from here. I don't think that happens. Some of your gains is in the Dow going down. So this is, you go short the Dow, long the gold, you get your multiple of 24x. If the Dow halves, which I think quite easily.
We are approaching a historic financial shift during which gold is expected to dramatically outperform silver and traditional equities. Given the potential for a significant crisis and extreme market volatility, their strategy stresses stacking gold heavily now and waiting for clear signals before shifting into silver. Preparing ahead of time will be crucial as we move toward a new financial system reset. At what key signal does the speaker suggest switching from gold to silver? Why does the speaker believe silver will remain suppressed longer than gold? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content.